3 questions and steps. That's all you need to catch trading setups like the one you see on my screen. In this video, I'm going to show you how to plan this into a simple step-by-step trading strategy. So let's jump into the video. In this strategy, we are only going to be using 2 time frames. The higher time frame to build a main trend narrative, and the lower time frame for the trade execution itself, when we will clarify what type of entry setup we will plan. So starting with the first step, being high time frame analysis. Now here it all comes down to just 3 simple questions you need to ask yourself. Is the market bullish, or is the market bearish? If you struggle to understand that, don't worry, as I will explain very simple and clear on the charts. Then when you have properly identified the direction the trend is running into, we move into the second question, and that is to ask ourselves if the market is currently following a continuation, or if the market is currently following a pullback. And the third question you need to ask yourself is, where is liquidity resting on the market? Basically, where are levels of liquidity, especially in form of stop losses? We are going to go deeper into that. So right here in this bullish example, on bullish markets, we know that the market forms this structure of an upwards impulse. That is followed by a slight decrease of price shown with a pullback. And the uptrend is held as long as the market structure continue this price structure of higher highs and higher lows. So we have identified the trend. So first step is checked. Now moving into the second step, is the market right now running into continuation? Or is the market right now running into a pullback? The market currently is following a pullback because it has recently broken up the last high, meaning that we got a bullish break of structure. On uptrends, after a break of structure, the most common move is a pullback towards the lows to form higher lows. Now we would move into the third step. Where is liquidity resting? Well, this is when we meet this problem. The liquidity is often seen on low time frames on the internal price action. And because we are only on the high time frame, we can't see probable liquidity sweeps. Because in here, if the market would take out the higher lows into making lower lows, this would actually be a market structure shift that reverses the uptrend into a downtrend. Liquidity sweeps or inducements, however you want to call them, they are seen more often on the lower time frames inside the internal price action. What we actually see once we zoom into a lower time frame to clearly see the internal price action is a market structure that looks more like this. So the straight up upwards push is actually just multiple mini uptrends with internal higher highs and internal higher lows. This finally sets in a swing high from where the price starts the pullback. The pullback is seen internally on the lower time frames with a market that has multiple mini downtrends. So actually the pullbacks in the uptrend is a low time frame downtrend. Then here is where we need to pay attention because we cleared the first 2 steps. So getting into the third step, we need to identify levels of liquidity. Usually these comes in form of equal lows or swing lows being taken down just for the price to move back from where it has swept from. More experienced traders might ask that this looks like a market structure shift. So how do we understand the difference if we meet a market structure shift that actually reverses the trend? Or a liquidity sweep that prepares the price to move impulsively into the main trend? Well, there isn't an objective system to make sure we get it right every time. It's more subjective. The solution is to simply just wait to see what the intention of the price. If the price breaks down aggressively and doesn't look like it has strength to recover back up, then this would be more than likely a market structure shift. But if the price breaks down and quickly reverses back up, well, this shows a high probability that this move was a trap or a liquidity sweep. In this case, the market might soon push to the upside, moment where we would look for a demand zone to buy from in order to move the market into new highs. The setup itself is a buy position, because our goal is to follow the trend and have 2 options on planning the setup. We can look for buy setups on the higher time frame demand. This makes the setup a swing trade. And if we want to scalp the market, once the price hits the high time frame demand, we closely zoom and look into the low time frame for an internal market structure shift. That flips the market from a low time frame downtrend into a low time frame uptrend, basically aligning the low time frame trend with the high time frame trend. So now the structural formation applies for the internal price action. That would be a pullback that forms a higher low, moment where we look for a low time frame demand, or a low time frame imbalance. And we can scalp this with a buy setup in here. The time frame zooming is up to your choice. A great one I found that works well is the 1 hour time frame into the 5 or 15 minute frame. I wouldn't go below into the 1 minute because of many false breaks, many more liquidity traps, and often a much harder price action to trade. So that was the plan in case the market is bullish. But what if the market is bearish? Well, when we win or lose a trade and leave, usually I take a break between trades. I don't take more than one trade per day, even days without any trades, because I want to identify the highest quality setups. So when coming in again on another day, we start again from the question 1, the high time frame analysis of the trend. Is this market bullish or is this market bearish? Well, anyone can see how the price decreases over time by forming lower highs with lower lows. So we know that the high time frame trend is bearish and following a downtrend. Now we ask the second question. Is the market in a continuation phase or is the market in a pullback phase? Right here at the most recent price movement, the market just rejected down and looks like it is ready to move into the lows. So we are in the continuation phase. So in the continuation phase, the trades have already been triggered and might be a little late to enter right here into the market. In this case, I would prefer to wait for the market to break into the new lows for a break of structure. As I said earlier in the video, after a break of structure, we expect a pullback phase, and a pullback in a downtrend is seen as a low time frame uptrend, and we look for the external supply, or a bearish fair value gap. But before the trade execution, we would need to see the market take out liquidity. But the problem in here is that we are still inside the external price structure, basically inside the high time frame trend. So to properly identify where does liquidity rest, for the third step, we need to zoom into a lower time frame. And on a lower time frame, this price structure looks like this. So the move towards the external lower highs is a low time frame uptrend. An uptrend that fails to continue and breaks down into a market structure shift on the low time frame, which flips down the low time frame uptrend into a low time frame downtrend, and the move towards the lower lows are just low time frame internal downtrends. And this price structure repeats as long as the market holds a high time frame downtrend. Now, because we look to trade with the trend and especially with the higher time frame trend, we also have two options here. We can look for an external supply to plan the sell setups. This is the more simple but slightly more ineffective plan. We can optimize or increase the quality of the setup, and that would make this a scalp position. We can do that by still aiming for the price to hit the external supply or fair value gap, but we don't trade it directly, and instead, we look inside the internal price action for the market to reject it down from the supply, form a market structure shift, and that shift should validate an internal supply or fair value gap on the low time frame, if there is one, of course. If not, we can jump into the next setup until we find the opportunity. But if we do find one internal supply or gap, we look to sell short with multiple target options. Can be either to the external lows, making this a very high risk to reward setup, however more risky and more likely to get stopped out. Or we can make it a scalp position targeting somewhere near the internal lows. So let's get right into the charts. This is the gold market on the 1 hour time frame. We start with the first step, high time frame market analysis. So right at the beginning, we've got a bullish internal trend that is aligned with the higher time frame trend. Basically, just a market forming the uptrend structure of higher highs and higher lows. Now we have here an interesting wick to the downside. This was more than likely a liquidity sweep. Even if that wasn't the intent, it still has taken out all the stop loss that were resting below these lows. And we also know that right after a liquidity sweep, the market pushes aggressively to the exactly opposite direction, which has happened in here because the same candle closed very bullish, with a closure above the last candle, and as well as a higher high from the previous candle. But based purely on market structure, this is still a bullish market, because that wick has not broken below the lows. So this holds the last lows as protected swing lows. Then we clearly see how the market has held a continuation of the uptrend for a while, but after marking a swing high, the market started pulling down significantly with increasing sized candles. More importantly, it has broken down below wick low, marking a bearish market structure shift on the high time frame. What we would have expected after a bearish structure shift is a small upside pullback that gets faded out and broken down by a formation of lower lows. But we see that this has not happened in here, and instead we got the upside pullback which is expected. But then instead of breaking into new lows, the market actually has stopped the downside movement above the last lows, so simply, it has formed higher lows. This shows that sellers are not strong enough to push the market. But as well as it says, there is not interest to take the market lower, because there isn't any liquidity or large pending orders to close or to open. Then after that mark of higher lows, the market bounced up into new internal highs, basically forming the bullish breaks of structure. We make sure to mark the important ones. So we've got the initial break of structure, then we got the next one here. Now what happened is that this bullish price action has continued with many upside candles in a row, and then quickly pulled back down but higher than the last lows. So new formations of higher lows and higher highs, and marking the next break of structure that pushed into the highs. And now, because we are in the recent price action, we need to analyze why the last structural move has happened. The last structural move is the upside push that breaks into the last highs. Now we see that it has bounced up from this support, or breaker block, or whatever it is. The important factor is that it has bounced up directly here and has not broken down. This is a very important detail to understand, because it shows that the market is responding positive to bullish entry structure. So whatever bullish structure you're trading, like supports, demand zones, order blocks, fair value gaps, the bullish structure are respecting at this point. And knowing this detail, we just look to replicate the plan once again. So what we'll be looking towards is to take the market into new swing higher highs, basically a formation of another shift, but to continue into a newly formed uptrend since the downtrend has failed to print even a single internal bearish price movement. So, what we would expect in this case is a pullback to the downside on the internal structure, with its downtrend characteristics of lower lows and lower highs. Then, some kind of low time frame market structure shift towards the bullish side, looking for a bullish entry model near the lows to take the market into new highs with a buy position. So that is basically the plan. What can also happen is that it deviates away from our plan, because of course, wrong things can happen. The worst case scenario would be if this market structure shift that just formed at the highs, if this would actually be a trap, and then it initiates a downtrend structure to finally break below the swing lows and reverse into an internal downtrend. In this case, if we would look for buy positions, they are in danger and probably closing with a loss. One of the only things we can do is to simply have patience. And the other helpful factor is to zoom into a lower time frame to observe the price action more clearly so that we can understand the market's intention sooner than we would if we were on the high time frame. And zooming into the low time frame is the next step that would come anyway. So, zooming into the 5-minute time frame, and in here we've got many buying opportunities. Actually, we got too many. There is a demand right here. There is another demand right above. And there is another one here. Now, how can we know where the market would bounce up from? Well, we can't know for certain. So the only thing we can do is to filter out and have as less demands as we can. Now this upper demand, I don't like, because the next candle from the demand wicks down below, the last candle that has formed the zone. This would be a lower quality demand, so we filter it out. And make sure the demand zone covers the candle highs and lows. Now, there are also smaller internal demands in the upper price action, and we know that they worked. This doesn't help as in entering that certain setup itself because the trade already happened. But because we see that demands have worked recently, it favors and increases the chances that future demands will respect. And we start testing from the upper demand to the bottom. If we get stopped out, it's all right since we should have a great risk to reward, so a loss is easily taken out by a winner. So here, buy at the demand, stop loss below the demand, which also coincides being slightly lower than these lows. And for the take profit, we can look above the swing highs, and if the risk to reward might seem too high, we can also take partials profits. So at 1 to 3, we take out 50% of the position. You can also move the stop loss into the entry, so even if you get stopped out, you close the position with some profit as long as the first take profit has been hit. And the rest, 50% of the position, can be targeted towards the swing highs. In this way, you decrease the effective risk to reward ratio while also securing some profits. And it is moved into the take profit, a pretty clear and simple setup. Now if we zoom out, we can see that what the market has done is just breaking the high time frame highs, just like we would expect. Now because the uptrend has confirmed, we would be looking for a pullback phase to the downside, moment where we could look for buying setups to take the market into trend continuation. Alright, into the next one. This is the Nasdaq on the 1-hour time frame. So again, we go step by step, starting from the first step, which is simply just analyzing the market on the high time frame. So what we see here is an initial downtrend with a final significant downside move. Then we got the pullback phase as expected, but then, instead of forming lower lows, it actually pulled back down, and the pullback ended higher than the last lows. So we basically got higher lows. Meaning again, that sellers lost their strength. Notice how the wicks instantly rejected with the candles to the upside. It shows the intention that the market is not interested into moving lower, and this wick structure and appearance of bullish candles start giving confidence to buyers, which eventually push the price pretty aggressively towards the highs. Now this upwards push breaks two important structural levels. It breaks above this high, which marks an internal market structure shift towards the bullish side, but it also breaks above the swing highs, which marks the external market structure shift towards the bullish side, so both the internal trend and external became very bullish. So this is what actually happened seen on a price action presentation. We've got the downtrend formation with lower lows and lower highs, and then sellers exhausted their orders, and the price broke up above the internal high, and this caused an internal uptrend which eventually moves into the swing highs and also breaks them up. So we have confirmed an uptrend. Now on the last candles, after a break of highs, we would expect to enter a pullback phase, taking the market somewhere above the last lows, forming a higher low moment where we would look for entry structure to plan a buy setup to essentially just follow the trend into new highs internally, but also externally if we would look for a swing trade. And to see this more clear price action, we zoom into a lower time frame trend near the last price movements. So zooming into the 5-minute chart, and this is how it looks. So we've got a downside small pullback. Then it looks like the pullback is about to end. If we're looking at the last candle, it's looking like it's about to move into the highs. So considering this as a high time frame demand, for a validation of the demand, we want the market to break above the highs, which is also the most probable move in here. If it does not break above, then this demand is invalidated. And it actually did broke above. So this is just an internal break of structure, of course, to be bullish side since it broke the highs, and the market is pulling back towards the demand and bounced up right away from hitting the zone. So this demand, not that only it validated, but it has also been respected, and could have been a buying setup for traders, but I used it to wait to see if the market respects demand zones, and now we confirm that it did. So we can actually look for more demand zones until, of course, one will fail. And the main target for this market is to move towards the swing highs since we flipped into an uptrend. Now demand zones are found near price movements that have breaks of structures attached to it. There is the break of structure internally right here, and the candle responsible for the breakout on this price action is this candle. Based on theory, this is the demand candle. Now we can place a buy setup on the internal demand. This is a scalp, by the way. With, of course, the target, you probably already know the theory of the targets. Usually the stop loss below the demand or near below last lows, and the take profit above swing highs or near above internal highs. And we can also zoom even on a lower time frame just to see the price movements in more detail. Here we got another break of internal highs signaling that we are trading in the right direction of the market because its interest is to have higher prices at this moment in time. And finally, after some minutes, it has moved into the highs, closing the position. This has logic to it, especially if I zoom out. You should understand why we were looking for buy positions. Just look at this price movements of constantly going higher. Why would I look to time the market for sell positions if the price is showing on the chart that it follows an uptrend currently? Another one, this time on stocks, more specifically on the Apple stock. This might look simpler because it has less candles, but the steps are the same. So the high time frame structure has this upside impulse that is followed by a downside pullback and another push towards the highs, which is soon after faded down because the market looks like it entered into a massive downturn. But until then, we should carefully analyze especially the external trend since we are on the 1-hour chart. Here we got the break of the swing highs, so simply a break of structure towards the bullish side. After a break of structure, we usually enter a pullback phase. But this time, it seems like the market just continued going up. Simply said, buyers had so much power that the trend just hasn't exhausted, and instead, it kept going on. That doesn't sabotage us, just means that without a pullback, we simply can't find setups there. but that's not a problem. We just look for other opportunities. And we should also pay attention to the internal structure, however, is not that important at this point. The only important factor of the internal trend is that price broke down below these internal lows, basically forming an internal downtrend afterwards. So simply said, this was the market structure shift on the internal trend. Now, if the market would have kept its uptrend structure, we would see this internal downtrend structure end above the external lows to basically form higher lows, just like we have on uptrends, and that to eventually form higher highs where traders follow with buy setups. But what happened instead is that the market also broke down below the external swing lows, which has formed the high time frame market structure shift. This flips the high time frame trend into a downtrend. So now we look for sell setups instead of buying setups. And after a break, we enter a pullback phase. A pullback phase on an uptrend is seen as a low time frame uptrend with its higher highs and higher lows, with eventually the pullback breaking down and entering into a continuation phase caused by an internal market structure shift. Moment where we can look for bearish structures like supply zones, resistances, fair value gaps, or whatever selling setup you trade, because the plan is just to take the market into new external lows by constantly forming bearish breaks of structures since we are confirmed in a downtrend. So now we look into on the last movements. And to see a more clear view of the upcoming movements, we zoom into a lower time frame where we can also identify a potential liquidity sweep and also a trading setup. This time let's move into the 15-minute chart, because on all setups so far I entered on the 5-minute time frame, and this is not a set-in-stone strategy. You can be pretty versatile with your planning. The important factors is to understand the market structure itself. Now usually we get these buy or sell structure closer to the break itself. And here on the break we see this large, aggressive, bearish candle. This type of large candles most of the time leave an imbalance on the market. And it has an imbalance or a fair value gap between these candles. However, we see that the gap has already been filled. And this itself would have been a great setup. So we need to find another sell-side entry structure. We got a downside push, a pullback, and a continuation towards new lows. So a bearish break of structure right here. Now the nearest entry model that is closer to the break of structure was the fair value gap that already got filled. But there is also a supply zone formed from the candle that has caused the continuation of the downtrend, being the last candle before the downside impulse. Then soon after the downtrend continued, however, that's not that important. The important factors is that there are internal highs that can act like liquidity, with probably stop losses above. The intention of the market is moving towards liquidity, and considering the supply zone from the above, the most optimal scenario would be for the market to move into the supply zone, which would give traders a selling setup that has been prepared by liquidations from the internal highs that would be taken out if the market would move into this zone. And if the market does not move into the supply, we just skip into a new opportunity. But since this is a backtest, I place all trades. So stop loss above the zone. Take profit below the lows, and we wait for the market to do its thing. So here we got the next market open right at the first internal high. This now has pretty high chances that it will break above, and it broke above with a wick. The position also got triggered, and the market instantly rejects back down, slowly moving near the take profit area. Now here this is also an interesting case because there are many equal lows at this level. So actually this position could have been even taken with a better take profit target. The reason is because if there are a lot of equal lows, those traders with positions near that level more than likely have their stop losses below the equal lows. And because the market looks to move towards liquidity, it has high chances that it could take out some of those stop loss, so basically pushing the market slightly lower. That's it for this video. You can find my resources on the link in the description, and if you liked the video, leave a like, and also feel free to take a look on the community tab here on YouTube, where I share more useful posts.